Hey everyone, welcome back to In Her Wallet, a weekly podcast helping women around the world take control of their finances for good and build better financial futures one episode at a time. My name is Sofiia. I'm your host, the founder of In Her Wallet, and an accredited investment representative here in Canada. What I want to talk about today is how to choose the right investing platform. The idea for this episode came to me recently as I personally just switched from one investing platform to another one. And having gone through that process of doing research and analysis of the best options available on the market, I thought, why not share that experience and key takeaways from that process with you guys? So, my goal is that in this episode today, I'm able to simplify the process of choosing the right investing platform, specifically for us women. Before we dive into the details, I want to take a moment to acknowledge the importance of investing. Investing provides us with an opportunity to grow our money and wealth, to become financially independent and achieve that financial freedom everyone is talking about, and also to meet our long term goals, which is especially important for us as women because, first of all, we outlive a man. Our life expectancy is longer, so we need to make sure that our money works for us in the long term. And also, we are disproportionately affected by the gender pay gap. So, it's twice as important for us as women to make sure that our dollars are working for us. In a nutshell, investing is about buying and selling securities, which is a fancy word for stocks and bonds. These securities can be bought on the stock exchange, and stock exchange, in a nutshell, is like any other marketplace you've probably been to. Imagine market on the Granville Island here in Vancouver or any other farmers market. Back in the day, stock exchanges used to be a physical place. Remember that Wolf of Wall Street movie with men yelling and pointing in suits, holding pieces of papers in their hand? Well, not anymore. These days, stock exchanges are digital, and that means that you can get access to all the largest stock exchanges in the world through an online trading or investing platform. And that is like any other online store you've probably shopped through. So, today I want to help you understand the different types of online investing platforms, their benefits and disadvantages, and how to choose the one specific to your own needs. Okay, to get started, let's talk about the three major types of investing or trading platform available in this day and age, and that is traditional brokerage firms, robo-advisory platforms, and do-it-yourself platforms. Each has its unique features, advantages, and limitations, but first let me walk you through what each of this means. First one is traditional brokerage firm, and that one assumes working one-on-one with an investment advisor who manages your money on your behalf. These professionals usually have expertise in financial planning, investment strategies, and market analysis. Every major bank like RBC, CIBC, Scotia, Charles Schwab, and Fidelity would have a wealth management arm like that. And also, there are boutique investment management companies. In season one of In Her Wallet, we hosted two guest speakers, Jessica Keyes of Wellington Altus Private Wealth and Robin Thompson of Castlemark Wealth Management. So these would be your examples of boutique investment management companies. Then we have robo-advisory platforms. These platforms have gained immense popularity in recent years, primarily due to their hands-off and low-cost investing approach. Robo-advisory platforms use algorithms and computer models to automate investing process for you, so they are a great fit for new and beginner investors. Examples of such platforms here in Canada include Wealthsimple and Questrade, and in the US it would be Betterment and Wealthfront. Finally, there are do it yourself or DIY investing platforms. They are online platforms that provide tools, resources, and access to investment products for individuals who prefer to manage their investments on their own independently. DIY platforms are best suited for experienced and knowledgeable investors who are cost conscious and want to combine the best of both worlds, traditional brokerage firms and robo advisors. Examples of these platforms here in Canada include RBC Direct Investing, Questrade, and Simple Trade. And in the US, it would be Robinhood, E-Trade, and Fidelity Investments. This is personally the type of platform I use for my investments, and the recent switch I talked about in the beginning of this episode actually happened from one DIY platform to another DIY platform. So you understand that even if companies are within the same group of investment platforms, the same type of investment platforms, there can also be differences which are worth switching for. Now that I gave you a quick rundown of each of these platforms, let's take a closer look at disadvantages and advantages of using each of these types of platforms for yourself. Starting with traditional brokerage platforms. Advantages include obviously expert guidance and personalized advice that you get from working with an investment advisor one on one. Also, research and analysis are a big part, as normally these types of companies have extensive research departments that conduct in depth analysis on various investment opportunities. Companies like that would offer you market reports, company profiles, economic forecasts, all so that you and your advisor can choose the best investment options for yourself. By the way, a lot of this in depth analysis and market reports in a simplified language will be available on the In Her Wallet membership, which we're launching shortly this summer. I'm very excited for it, so stay tuned if this is something you are interested in. Now, it's important to mention that all of these advantages that I just mentioned about traditional brokerage firms come with its own costs. Primarily, the fees and commission you end up paying for that service, which can quickly eat up into your investment returns. So, the best fit for this type of platform are usually high income earning professionals who are very busy with their work, also entrepreneurs who have monetized their businesses, or company executives who have very concentrated portfolio positions and need help with diversification. Another disadvantage I want to mention is that usually traditional brokerage firms have very high account minimums to be able to work with such professionals, and it is also very important to do research on the platform that you are considering to start working with, and also to do research on the investment advisor themselves, because this relationship is very personal and is built on trust. Now, let's do the same for robo-advisory platforms. As I mentioned earlier, they are a great fit for new and beginner investors. And the primary reason for that is because robo-advisory platforms, in a nutshell, are traditional brokerage firm, but it's not the human that manages your money on your behalf, but it's an algorithm. So amongst the advantages of these types of platforms are automated portfolio diversification and auto rebalancing. Also, robo advisors invest your money in various securities such as stocks, bonds, and ETFs, spreading the risks and aiming for optimal returns. Moreover, these platforms have a low cost structure and oftentimes no portfolio minimums at all to get started. But obviously, all of these advantages come with its own costs. And here are a few things to consider. Big one for me personally is the fact that robo advisory platforms typically offer a selection of pre constructed portfolios composed of ETFs or mutual funds. While these portfolios aim to provide diversification, they may have limitations in terms of specific investments choices or customization. So, if you want to invest in a particular company and it's not included in that pre-selected portfolio that you're offered through the robo-advisory platform, that might be a disadvantage for you. Another big disadvantage for me personally is robo-advisory platforms dependence on algorithms, which might still carry biases in times of market turbulence and unique situations such as the global pandemic. The automated nature of robo advisory platforms may not provide the certain level of adaptability or human judgment that some investors may desire. Another risk is a lack of human interaction and big importance placed on understanding the investment approach robo-advisors has and whether that aligns with your style. Even though it's a very hands-off type of investing platform, you still need to understand what those pre-constructed portfolios are aiming to achieve, whether they are investing in sustainable companies, or whether they are just created to follow market indexes, or maybe following a more of a passive investing approach. You need to do your own research to make sure that it aligns with your own goals and values. And finally, let's look at the advantages and disadvantages of DIY investment platforms, which I am personally a user of. When it comes to advantages, unlike robo advisory platforms, these types of platforms offer control and flexibility over your investment decisions. You can choose your own stocks, ETFs, and other investment vehicles based on your own research and analysis. This level of control allows you to tailor your investments to your specific preferences, financial goals, time horizon, and so on. Another big benefit is cost effectiveness. DIY platforms often offer low cost trading options, allowing you to buy and sell investments at a relatively low cost compared to traditional brokerage firms. Additionally, some platforms offer commission free trading for a certain period of time or a certain number of trades when you sign up as a new user. DIY platforms are also very user friendly. They make it easy for you to research any company or stock and also have a look at your portfolio. Oftentimes, platforms like this have phone applications so you can access all your investments on your phone. When it comes to disadvantages of DIY platforms, as I mentioned, you need to be an experienced and knowledgeable investor in order to feel confident with making your own investment decisions. Another one is you need to take time to research the fees and commissions associated with a particular DIY platform. The switch I recently made was exactly due to that, plus customer service that I wasn't really happy with. So, even though DIY platforms in general are very cost effective, you do need to do your own research to understand what a particular platform's fees are. Some might be charging you account maintenance fees or trading commissions and so on. So you got to understand that. Well, this was a lot to take in, but I hope I was able to simplify the whole process of selecting the right investing platform for you. Remember, the right investing platform is a personal choice that aligns with your own goals, preferences, and risk tolerance. And if you need help, feel free to reach out. I'm always here for you. But also stay tuned for the launch of In Her Wallet membership, which will become your bestie in growing your money and wealth and achieving that level of financial freedom. I thank you all for your time today, and I'll see you next time.